You've been told your entire life that the golden years of retirement are just that, golden. But what if I told you that the very strategies meant to safeguard your future retirement could actually be setting you up for a financial tightrope walk? You see, over the years, we've seen hundreds of Canadian people retire, and we've helped many of them successfully navigate into and through those golden years. But every now and then, we come across scenarios where truly mission-critical errors have been made. Sometimes they're recoverable, other times the damage has already been done, and they turn out to either be unrecoverable or at the point where massive lifestyle changes are required to course correct. It's not where you want to be when planning for your retirement. So in this video, I'll highlight the 5 scenarios we've seen well-intentioned retirement plans fail. And along the way, I'll help you see what could have been done differently to improve the situation. Hey, I'm Steve Willems. I'm a wealth advisor with the Willems Wealth Planning Group out here in BC. We started this channel to help you plan for your own retirement, helping you think about how to arrange your investments, your income streams, and ideally have you pay less tax along the way. So let's dive in and start with the first scenario, what I'll call the liquidity trap, which is when assets can't cover lifestyle needs in the early years of retirement. This situation where retirees find themselves asset rich but cash poor. This occurs when the bulk of your retirement savings is tied up in illiquid investments. That could be real estate portfolios, private business ventures, or long duration development deals. Now, while these assets may represent significant value on paper, their lack of liquidity becomes a glaring issue when regular income streams dry up as you step into retirement. So imagine this. Imagine maybe you're an incorporated professional, say a physician, who owns several rental properties and a share of a private company. On paper, your net worth might be enviable, but when it comes time to convert those assets into the cash needed to fund your day-to-day expenses, you hit a wall. Real estate can't be sold overnight. With rates higher and rents capped, out here in BC at least, many aren't cash flowing like they used to. Private business interests are not only hard to sell, but they also might not yield the expected returns when you're under pressure to sell. A more simple case could just be that if the majority of your wealth is tied up in your Canadian principal residence, which just so happens to have increased massively over the last few decades, again, asset rich, but cash poor. And here's where the strategy falters. The timing of cash flows is out of your control, precisely at a time when managing predictable income becomes really, really important. This liquidity mismatch can create not only financial strain, but also significant anxiety as you realize your assets can't be readily available to cover the lifestyle that you had planned for. The missed opportunity here comes in pre-planning. Transitioning a portion of your portfolio to more liquid investments in the years leading up to retirement can provide the flexibility that you need to cover your living expenses without the stress of needing to sell illiquid assets at really terrible times. As you approach retirement, you need to consciously adjust the balance for high-value long-term investments on the one hand, with the need for accessible funds to support your retirement lifestyle on the other. The best way to map this out is with an actual documented retirement plan showing the timing and estimated sale value and tax consequences of all of those moves ahead of time, which can allow you to minimize surprises that you'd face when the time actually comes. Now, moving on to our second scenario, we encounter what I'll call the conservative conundrum. Now, this scenario arrives when retirees are aiming for what they would say is a risk-free retirement. They'll tilt their investment strategy heavily towards ultra-conservative assets. So here we're talking things like just cash, GICs, term deposits, things like that. Now, while the intent is to protect capital, this approach often overlooks a silent but relentless risk, and that's inflation. As we've certainly come to realize over the last few years, inflation gradually, or sometimes rapidly, erodes the purchasing power of your money, making it increasingly challenging to sustain your desired lifestyle over the long haul of retirement. Consider this. Historical inflation rates in Canada have averaged around 2% a year. And while this might seem low at a glance, for a period of maybe 20 or 30 years, this mild inflation can significantly diminish the value of your savings. For example, a 2% inflation rate, $100,000 today would be worth approximately $60,953 in 25 years. This erosion of purchasing power is particularly perilous for retirees who have decades of time ahead of them. We're all living longer after all. The risk of being overly conservative with investments is that your retirement savings may not keep pace with inflation, gradually losing their real value over time. So here's the data. The gold line is the Canadian inflation rate going back to the year 2000. And the blue line is the average 1-year GIC rate updated on a weekly basis, again up here in Canada. So over this period, the GIC, assuming it was renewed every single week to the freshest rate, which, to be clear, isn't even possible, it lagged inflation at 0.66%. Now, it's a small percentage, but run that out over decades, and it can have a massive impact. This could mean having to cut back on expenses, alter your lifestyle, or in some cases, outliving your savings. The key to avoiding this pitfall isn't to swing to the other extreme of high-risk speculative investments, but to find a balanced approach, including a mix of growth-oriented investments in your portfolio, such as equities, can offer the potential for returns that will outpace inflation over time. Diversifying across all of these different types of asset classes will not only help you manage risk, but also positions your portfolio for growth. And it's going to provide that buffer against inflation and preserving your purchasing power. Now, next, we'll confront a surprisingly common oversight, and one that's related to actually this last point, and it's the misuse of TFSA accounts, or the TFSA trap, as we'll call it. Now, many Canadians view their TFSAs as mere savings accounts, parking cash in them and then earning minimal interest rather than harnessing them as powerful vehicles for investment growth. This approach significantly limits the potential of these accounts to contribute to a robust retirement. Again, let's break down some numbers here. Imagine you contribute $6,000 annually to your TFSA, but instead of investing, you leave it in a savings account at a 1% annual interest rate. After 20 years, you'd have approximately $140,756. Now, consider the alternative. Investing that same annual contribution into a diversified portfolio with an average rate of return of, call it 6%. In this case, after 20 years, your TFSA could grow to be worth $253,199. The difference is a staggering $112,000. Basic compound interest. The TFSA was introduced as a flexible tool for Canadians to save and grow their wealth tax-free, but its true power lies in its capability for investment. When used to its full potential, the TFSA can hold a variety of different investment types, stocks, bonds, mutual funds, ETFs, all growing tax-free in that account. This is tax-free growth combined with the power of compounding makes it an invaluable component of a retirement plan. Now, we also encounter a scenario that's the flip side of being overly conservative, and that's risky bets made in a TFSA or RSP. While embracing some level of risk is necessary for growth, veering into speculative investments can jeopardize your financial foundation that you've been setting for years. Now, the allure of quick gains here can admittedly be tempting, but the consequences of high-risk investments in these registered accounts specifically can be pretty severe. You see, unlike non-registered accounts where you can use capital losses to offset against capital gains in the future, losses in TFSAs and RSPs do not afford you this tax advantage. Furthermore, when you incur losses in these accounts, the contribution room is permanently lost. This means that if you invest $10,000 in a speculative stock within your TFSA or your RSP and that price of that stock collapses, maybe to zero, not only have you lost that capital, but you can't reclaim that lost contribution space. It's gone forever. And quite frankly, while that is bad, it's almost worse if one of these speculative bets actually hits the jackpot. Because when that happens, the behavioral challenge of actually selling and realizing those gains, either tax-free in a TFSA or tax-deferred in an RSP, is nearly impossible. I've seen people hold on to concentrated Tesla stock with 80% of their entire portfolio all the way up to the top and then all the way back down 50%, now waiting for an eventual recovery back up, which frankly may happen, but it may also not happen. Who knows? And that actually brings us to fail number 5, the diversification dilemma. This is a scenario where retirees who are nearing retirement, they put too much faith in a single asset class. Maybe it's real estate, stocks, or even bonds, believing it to be the silver bullet for their retirement savings. The reality, however, is that an over-reliance on any one single investment type exposes you to increased risk of financial volatility and loss. Historical market data shed some light on this approach. For instance, during the 2008 financial crisis, investors who were heavily invested in equities saw their portfolio suffer significant losses, while those with a diversified mix of assets, including bonds and other securities, maybe some real estate, experienced less volatility and had a quicker recovery time. Similarly, the real estate market downturn in the early 1990s and the mid-2000s demonstrated the risks associated with an overconcentration in real estate investments. They say diversification is the only free lunch. It's guaranteed to never be the best performing asset. Mathematically, that's impossible. But it's also insurance against a devastating loss that comes from concentration. You'll never have the worst performing thing either. So as your attention shifts from growth to preservation, diversification is your financial safety net. It ensures that if one part of your investment portfolio underperforms, the other, more resilient investments can buffer those losses, keeping your retirement plan on track. If any of these pitfalls sound familiar, or if you're unsure how to navigate them, you're not alone. We've seen these scenarios play out one too many times, often with pretty nasty consequences. If you'd like a hand avoiding any of these traps, we've set aside a few time slots every single week to help folks get answers to their questions. If you'd like to grab one of those time slots, I'll put a link in the description below for you to take advantage of that offer. Hey, thanks for joining me today. If this video shed light on areas of your retirement plan that need attention, feel free to share, like, or subscribe for more insights. Feedback is really so appreciated. Really helps make sure that we're developing content that helps you make better retirement decisions. So with that, take care. I'll see you in the next video.